Hey everybody, Glenn Tompkins and welcome to our YouTube channel. Today's video is going to be an important one. Inflation is such a hot topic right now, so I'm going to put some things, try to put them into perspective and utilizing the VectorVest system to help you to make the right decision. So this video is all about inflation, the economy, and stocks. And by looking at each one of these things to help you to determine what you need to do, what to prepare for, and how to best take advantage of that. If you're interested in knowing how these things can affect how you invest in the market to give you a better understanding, you sit right there. Hey everybody, Glenn Tompkins, Senior Instructor here at VectorVest, still working it from home, but it's all good because I still love bringing these videos to you. If you are brand new to the channel and haven't already, please hit the subscribe button. This is the kind of information that we bring to you on a weekly basis, almost pretty much on a daily basis. If you like the content, by all means, please hit the like button, share this. Share this with people out there to let them know what we're doing over here so we can better educate. We're not fanatical about this, that, or the other thing. It's all about education. We do the work, you reap the rewards. Once again, my name is Glenn Tompkins, Senior Instructor here, and we're going to start off by getting a better understanding of what inflation is, how we got to where we are right now, and it was all because of the Fed. The Fed did it for the purposes of lifting the economy. A couple of big things that have happened in the last 14 years that made the Fed do what it did in regards to lowering interest rates to keep the economy afloat. Of course, we had 2007, 2008, the housing bubble, and to keep the market, and we were on the precipice of going into a depression. That's my personal opinion. The Fed stepped in and started lowering interest rates. Why? To make money easily attainable for people to get. And if they could get the money by borrowing money at a lower interest rates, they can now have more consumable money to put back into the economy to keep the economy going. Now, what else happened? 2020. COVID-19 pandemic hit, the Fed still did the same thing. To help to bolster the economy, they lowered interest rates, and now we're sitting at historically low rates. Now, there's the other side of that. With all of the money now being put into the economy, prices run hot, called inflation. Prices for goods go up. Prices are inflated. And that is the downside to what we've done, what the Fed has done, in order to keep the economy going. Now, it's the Fed's job to do three things: earnings, interest, and inflation. All right, well, now that's the three things that move markets globally. They have to look at interest, inflation, and jobs. Interest, inflation, and jobs. So they're doing what they need to do to stymie the economy, keep it up, not stymie, but to keep it up by having low interest rates. But they also have to keep inflation in check because that's the product of lower interest rates. Now, therein lies the problem. We now have a lot of money out there, interest rates are still low, and inflation is running away. So, now they've got two things to combat at the same time. Now, the most recent rate possibly to increase was the last meeting that they had, or the last meeting that they had, where they said, well, we're going to raise rates starting in March. They could have started raising interest rates right away. A lot of people say, well, it's baked in. We know that the market is going to go down. Why not just start raising the interest rates? I think that was kind of suicidal because they knew as soon as they did that, that the market was going to go down precipitously right then and there. So they didn't want to do that. So they're trying to make this as appeasable, for lack of a better word, to everybody, knowing that we're going to raise interest rates, but we don't want to just do it right now and stick it to the people and da-da-da. Well, there's two sides of that. Just pull the Band-Aid off and let us go have at it. Or you still push this out a little bit. We're still dealing with inflation. And then are you too late to the party to start to raise interest rates? So it all depends on what side of the fence that you sit on in regards to that. But let's take a look at a couple of things. Let's go out to the internet. And this came out today. The core personal consumption expenditure. Closely watch inflation gauge. Inflation gauge at the Federal Reserve rose almost 5% from a year ago in December. That was the fastest gain since September of 1983 and a touch above the Wall Street estimate. That's big still. So inflation is still an issue. They're still saying that they're going to raise interest rates, but should they have done it right away, or are they smart in that they're trying to do this as smoothly as they possibly can? Another part of the story, let's go see. Talking about inflation for those of you who are new to this, it's the general upward price movement of goods and services in an economy. So with the lowering of the interest rates to put more money into the economy, prices of goods and services go up, and that's where inflation is. So put those two together, that's where we stand as far as inflation. It's a bad thing. It's talked about all over the place. So I wanted to address that, and how we got here was because of the low interest rates. All right. So now, going back into the VectorVest software, we now have a better understanding of inflation, why it's bad, and what they are going to do. It's not like they are not going to do anything. They are going to raise interest rates, so it is what it is. Now, remember the time when they kept saying that, oh, it's transitory, it's okay, we got it all under control? Well, I've been saying for the longest time that it wasn't transitory, that it was a real problem, and now the question comes up, are they too late to the party to start to bring in inflation by raising the interest rates? So that's left to be seen. We'll see what happens, but they are now starting to burn the candle on both ends while trying to approach and go after inflation and lowering the interest rates at the same time. Will one outpace the other, and will we be in big trouble? Again, that leaves is left to be seen to see how that works out. But at least I'm putting it out there so it's something for you to think about. Now, when we talk about inflation, how does it affect the economy? The economy is still running. It's still running hot. We've got to bring it back in. But I also want you to look at some other things in regards to the economy. This is my other part of it. There's three things that move economies globally: earnings, interest, and inflation. Well, we've already been talking about interest and inflation. Let's talk about earnings, because that's also important. I'm going to go to our market timing graph. Oh, it was already here. Let's go to our market timing graph. And actually, let's go look at our market climate graph. This is something you'll only find in the VectorVest system. It's the 30,000-foot view of the market. You can't use this graph to trade stocks. It gives you the broad overview of the market so that you're standing up here looking down going, oh, okay, so that's what's happening. On here, we have the S&P index. You can see that it's running. It's recently pulling back as the market has been decimated. It's been hit. Again, I've used the terminology blood in the streets because stocks are getting decimated. People are looking at this as a great buying opportunity. My personal opinion in this is that I think we get one last hurrah before the Fed starts raising interest rates. Why? Because stocks are poised for it. The market is definitely way oversold. So we do get, I think, a bump up in the market. Do we take out the most recent highs that we've had earlier throughout the year or going into the end of last year? I'm not quite sure, but I still think that we get a nice rebound in the market because the markets have been so oversold. Now, after interest rates start to rise, it's going to affect the market. Why? Because the earnings perspective of companies will be affected. Once interest rates raise, it's going to make it harder for companies to borrow money. It's going to cost them more money to borrow money, which takes money out of their pocket, which takes money out of the bottom line. They'll start missing earnings. It'll happen. And I know that the market feels the same way because as soon as that does happen, we now know that the market's going to continue to go down, 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 down because the market is, or the Fed is taking the money out of the market, making it harder for people to put it right back into the market. So I'm looking at the S&P index, again, starting to fall, but look at the earnings trend indicator, only found in the VectorVest system. Earnings are still rising. Companies are still meeting or exceeding their earnings. Now, as I say that, many of you are going to be saying that, well, they're buying back shares. Okay, that's fine. They can normally only do that for a quarter. And then after that, the real number kicks in of not being able to buy back shares and earnings will be affected. We are still in a bull market, folks, and we have been since January of 2021, thereabouts, where our earnings trend indicator went across our value of 1, cast on that VectorVest scaling between 0 and 2. Went above, we're in a bull market. Market's been running. That's a beautiful thing. Now, as we start to raise interest rates, this will fall, and then we will officially be in a bear market once the earnings trend indicator on the VectorVest software goes below the value of 1, way back where we were here back in 2020. When was that? That was COVID. The market was so decimated at that point, and the Fed went and tried to build back up the economy by lowering interest rates, and look, it worked, right? Now, COVID hits, we got no control over that. Market goes into bear market territory. I think that with the raising of interest rates, we'll get back into bear territory, but we're not quite there right now. Keep that in mind. So I'm looking at, from an earnings perspective, the 50-day moving average of earnings per share on the S&P 500, still at an earnings growth rate of 9%. That's huge. That's just really, 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 really big. But again, with the interest rates, all of this will most likely turn around. So now let's flip our focus over to stocks. So from today, let's look at our market timing graph for today. Look at what's going on. Look at that. This is today, folks. 5-minute bars on the VectorVest composite. And everybody's jumping up and going, yeah, all right. It's time to go running into the market. The market's doing a rebound. We're taking out the session high from this morning. Everybody's saying it's time to go. It's time to rock and roll. Wait. Let's go put this on a 3-month graph. What kind of candlestick formation do we have forming today? We've got a level of a hammer. So what am I looking for before I say we get this last hurrah? Let's go start to see if we can start taking out these prior candles. This could be setting up for that last hurrah. I still think we got it. This could be setting up for that last hurrah. We need a couple of things to happen in the VectorVest system. We're looking for the primary wave. We're looking for a blast off day. And I still think that with the market being as killed as much as it is right now, that the market is definitely looking for a scenario. Let me take this off. Is definitely looking for a scenario for the market to take off. All right? But you can't outguess the market. The market's got to come to you, let it come to you. And once it does, you're going to get an opportunity, a great buying opportunity. But don't lose sight of the fact that we will be raising interest rates, that the Fed will be raising interest rates, and that's going to pull the market back down and effectively at some point in time get us back into a bear market. So from a stock perspective, what do you do right now? In the VectorVest system, I can always see what sectors are moving. I'm doing a 10-day RT delta. Delta is a percentage change, and seeing what sectors are on the rise over the last 10 days. I run that, and petroleum. Petroleum has been the sector that has been moving. It's up over 3.5% over the last 2 weeks, followed by utility market ETFs and so on. So if you want to know, once the market starts to rebound, when it does, and again, let it come to you, just be careful if you jump the gun before the market gives you the signs. These are the sectors that you can take a look at. You can right-click, look at a graph to see what they look like. So those are ideas to take advantage of from a stock perspective. So putting this all together, inflation is an issue. The Fed is working on it. Should they have done something a little quicker? We'll see. All right, but they are working on it. The economy is still rustling, is still going, it's still going, it's still going. Stocks are still making money. So earnings are playing a role into what's going on in the economy as well. And then at least some ideas of what to look for and what to look for right now before you just jump the gun. So putting all of that together, hopefully you now get a better understanding of how we got to the inflation we're at, what's going on in the economy, and what's going to change in the economy as we go after inflation, and then start to looking at what stocks to get into to take advantage of. Folks, this video is over, and until the next time, see ya.